Robert Talbut is Chief Investment Officer at Royal London Asset Management, joins me in the studio now. Mr. Talbot, good to see you.
Morning.
So where do you stand on risk right now? You for or against?
In the short term, I think it's probably a little bit risk off because I think we are into a period where we're all looking for the next policymaker's speech, and there is an enormous amount of uncertainty as to how the European crisis is going to play out. Ultimately, I think out of this could well come a very interesting pro-risk opportunity.
What do you mean by that?
Well, I think that things are coming to a head. I think that European policymakers are being pushed very much into a corner, and they're either going to have to decide that either the euro is going to break up, which could be a very, very disorderly environment, or they're going to have to adopt some policies that will be pretty pro-risk in terms of assets.
So it sounds like you're saying things will probably get much worse before they get better, and market pressure will perhaps force politicians to confront this dilemma once and for all. So what then do you do between now and when we actually do get something more decisive? What do you do in this interim period? Just stay away from risk completely, or, you know, is there also some opportunity there?
Well, I wouldn't necessarily advise people to stay away completely from risk, because the opportunity of being able to perfectly time that moment when you should be coming back into markets is incredibly difficult.
Yeah.
And it could happen an overnight event, an over weekend event. And if you're not in the market at all, that can be very damaging in terms of the performance of your portfolio. But I certainly would not be overextending your positions at the moment.
Yes, but I suppose because it's so difficult to predict what's going to happen, and because timing is absolutely key, if you do hold, if you do have the majority of your holdings in equities, well, regardless of what happens from one day to the next with the volatility, your advice is to just stick with it, but don't do anything else beyond that.
Yeah, but I think, you know, even if you were to look at equities, I think you could build a portfolio at the moment of, say, 20-odd names that will be strong companies with good balance sheets, good cash flows, good market positions, and actually providing you with a reasonable income as well. If you were to lock those names away for 5 years and not necessarily want to tamper with them too much, I think you'd be very pleasantly surprised with the overall return you receive over that 5-year time horizon. So I think the problem at the moment is that people are perhaps sometimes trying to just judge an intraday move, or actually price something to perfection, rather than actually taking a medium and longer term perspective, where I think there is real value around, not only in equities, but also in, say, corporate bonds as well.
Is it then more about what you choose to pay attention to as an investor? Because obviously we're all watching economic growth indicators, which by and large show that we are going to have sluggish growth going into 2012 at best. But nevertheless, corporate earnings so far haven't been too bad, have they, in both Europe and the US? And so what you're saying is to perhaps focus on the fundamentals of some of these companies, because there are some good dividends to be had there.
Yeah, well, I think what I'm actually saying is try and take a medium-term perspective. Don't get too bound up in some of the day-to-day, you know, tittle-tattle or news stories that are around.
OK, so geographically, do you like Europe and the US?
I don't particularly like Europe, because I think Europe is the region at the moment which almost has a recession baked in for next year, and I don't believe that's actually an earnings forecast. But I think if you actually look elsewhere around the world, there is still some pretty decent amounts of growth. Companies are still performing quite well. They're investing. Consumers are still buying. So the fundamentals, many other places around the world, are actually pretty respectable.
Are you speaking about building up a list of names there of quite healthy corporates? Is that, I mean, what sort of industry groups are you focusing on, do you like right now?
To be honest with you, probably almost anything apart from financials.
OK.
So I think if you go outside of the financials, there are some very good companies that have got exposures to the emerging market consumer. There are some very good industrial companies that have got in exposures elsewhere around the world. So, you know, you can build up a pretty good quality, high-yielding, relatively high-yielding portfolio that's producing reasonable growth.
And what about emerging markets? Because Of course, there had been, it seems as though what we've seen, European debt crisis hurting sentiment around the globe, including, you can see how it's impacted sentiment over in China. This idea of there being any decoupling, that hasn't materialized, has it? Do you still like emerging markets?
Yeah, on a fundamental basis, medium and longer term, I think emerging markets is a great place to be. And you should certainly be overexposed to those areas on any balanced portfolio on a medium and longer term basis. But the idea that they will completely decouple from the rest of the world was a nonsense and has been proved to be a nonsense.
And I'm wondering about the risks, because obviously they don't have excessive debts or deficits associated with them, but then there can be often the complication of dealing with, say, a company where there isn't a great deal of transparency when it comes to performance. So these are sort of things that you need to think about when you invest in emerging markets.
Yeah, you do also need to be a little bit careful about the price you actually pay for any particular business model. But I think emerging markets really just get bound up in the fact of whether people are prepared to take more risk with their portfolios or a lot less risk with their portfolios. And when they want to take a lot less, they take money out of developed economies as well as they take it out of emerging economies. But when they become more optimistic again, I think you'll see emerging market companies and markets doing very well.
Thanks very much, Anu, for joining us this morning. Robert Talbot, Chief Investment Officer at Royal London Asset Management.